So this lecture is going to talk about cost recovery. Okay, depreciation is cost recovery. Okay, that's the same thing as depreciation. And so depreciation is how you recognize the cost of an asset on your tax return over time. So if I purchased a very expensive piece of equipment that I expect to keep for 10 years, I'm not going to deduct the entire cost of that asset the first year that I purchase it. I'm going to spread that deduction over time based on whatever rules the IRS says that I need to follow. So the rules that I need to follow are called Maker's rules, modified accelerated cost recovery system. So there's a difference between Makers and straight line. Now, we used to be able to use straight line. Now the default is that we have to use Makers for tax purposes. So Makers is typically allows you to deduct a much higher percentage of the cost of the asset in year one. So the depreciation goes a lot faster. You have more depreciation in year one than you do in the final year of the recovery period. So the recovery period and recovery period and useful life is the same thing. Okay. So getting back to Makers, this is what we follow for tax purposes. We can still follow Makers and choose to use straight line, but we have to file a special election with the IRS to be able to do that. But for now, we're just going to learn about Makers. And again, Makers is a much faster depreciation method than straight line. So let's go over an example. Let's say that I have my own business. And remember, if I'm a business owner and I'm a sole proprietor, then I will file Schedule C. Get my 1040. And I'm going to purchase a vehicle to use for my business. So say, for example, that vehicle costs $20,000 for a vehicle that I'm going to use for my business. Now again, whenever we're talking about depreciation, we're talking about assets that you're going to use in your business. So I'm not going to deduct depreciation for the vehicle that I drive back and forth to Lone Star, right? I'm going to calculate depreciation on assets that I use in my actual business. Okay? So in year one, I purchase an asset, right? The vehicle is my asset. I purchase it for $20,000, and I need to use Makers. So the first thing I'm going to do is look at the table in Chapter 7. It's Table 7.1 to figure out, well, what's my recovery period? What recovery period do I need to follow in order to depreciate this asset, this vehicle, over time on my tax return? Okay, so if I read the descriptions, I'm going to look in the asset descriptions, and the one that I see that most closely relates to this vehicle is the 5-year asset. Okay? So for 5-year assets, that's where it says we're going to have all of our cars and light trucks and stuff like that. So I'm going to use the 5-year recovery period. Okay? So now if I want to see how much is my deduction for depreciation that I can take in year one, what I would need to do is go to Table 7.2. And Table 7.2 is going to give me what percentage of that asset's cost I need to take as a deduction in each year. So, for example, if I'm looking at this vehicle, which I has a 5-year life, I'm going to look in the second column, which is for my 5-year assets. Okay, and it tells me that in year one, I'm going to take 20% of the cost. In year two, I'm going to take 32% of the cost. So I'm going to deduct a percentage of the cost of this vehicle every year. Now, mind you, I'm going to have a year 6 where I still have a little bit of depreciation. Even though it's a 5-year asset, it might go into year 6 where you have a little bit more depreciation for that particular asset. But at the end of the day, I shouldn't deduct more than 100% of the cost of this asset. So if I add up those years 1 through 6 for depreciation deduction, I should never have more than $20,000 that I took as a deduction. Okay? So for this 5-year asset, for year 1, it says that I'm going to take 20% of the cost of the asset as a deduction. Okay? That 20 means 20%. So I'm going to multiply that 20% times the $20,000 that I paid for it. So my depreciation deduction in year 1 on my first year's tax return, the first year that I've actually had this vehicle, is going to be $4,000. Okay. So then year 2, the percentage that it says that I can use, again, looking at the second column where it has the 5 year, is going to be 32%. And I'm going to multiply that again by the 20,000. So then I get 6,400 is my depreciation deduction in year 2. Okay, so I keep going each year. Each year that has a recovery year on the side, the 1, 2, 3, 4, 5, 6, I'm going to take a small percentage or a large percentage of the cost of the asset that I purchased. In this case, it's my $20,000 vehicle. Okay. So the next thing we want to talk about is adjusted tax basis. Okay. Adjusted tax basis is the cost of the asset minus what we call accumulated depreciation. It's a little messy. So the accumulated depreciation means the total depreciation deductions that you've taken over time. All right. So in this instance, the cost of my asset was $20,000, right? The accumulated depreciation, let's say we're at the end of year 2. So I'm filing my year 2 tax return. I've taken $4,000 in year 1. I'm going to take $6,400 in year 2. So the accumulated depreciation that I've taken is $10,400, right? $10,400 at the end of year 2. My adjusted tax basis then at the end of year 2 is $20,000 minus $10,400 gives me an adjusted basis of $9,600 at the end of year 2. Now, let's say someone wants to purchase the vehicle from me. Okay? At January 1 of year 3. Now, how would I figure out what is my tax gain or loss? So whenever we sell our assets, if we have a business and we're selling our assets, we do need to keep track of our adjusted basis. We do need to keep track of whether we have a gain or loss that we need to include on our tax return. So year 3, we're going to figure out what's my tax gain or loss if I sell the vehicle for $12,000 in cash. Okay. So tax gain loss equals the proceeds minus the adjusted tax basis. So proceeds, that's what you're going to receive in exchange for what you're giving up. So what I'm receiving is $12,000. I'm receiving $12,000, and I'm giving up a vehicle with an adjusted basis of $9,600, right? $9,600. So my tax gain that I'm going to have to report on my tax return for year 3, because I'm going to sell it in year 3, on my tax return, I'm going to have a tax gain of $2,400. Okay? So we need to know our adjusted tax basis. We need to keep track of our depreciation in order to figure out what's our tax gain or loss whenever we sell our assets or our assets are destroyed in a fire or something like that.